every time the Federal Reserve has hiked interest rates aggressively, something has broke at the end of the day, right? And so this time it seems to be somehow different. But the reality is that it's not that government debt is the immediate problem when you hike interest rates, but it's private sector debt. So if you and I are overly indebted, if corporates are overly indebted, what happens is when you raise interest rates and you are forced to refinance, then if your salary hasn't gone up or your corporate earnings haven't gone up, hey, you have a problem, because all of a sudden you need to allocate more money to your debt servicing costs. And that is the mechanism that normally slows down the economy, right? Because instead of spending and doing a lot of travel and restaurants and discretionary spending, hey, if you have to refinance your mortgage at 7 or 8%, you're going to be thinking twice, right? Because a larger share of your salary will need to go to debt servicing costs. And so the debt service ratio, that is the metric, the most important one to take, to keep track of, because it measures how much of the private sector income is getting used to cover that cost, basically. If you look at the US, the debt servicing cost has gone up to 15%. The debt service ratio is 15%. That's exactly in line with the last 20 years. Not much higher than that. And why it has gone up so slowly is for three main reasons. Well, first of all, in the US, you don't have any floating rate mortgage, any floating rate corporate borrowing. Everything is on a fixed rate. So once you fix it, and most companies and households did before the Fed hiked the interest rates, well, then you don't need to refinance for a long period of time. So the Fed is hiking interest rates, but you don't really feel the negative effect because you don't have to refinance your interest rate. You have fixed interest rate for a long period of time. And then the second main reason is that the US private sector debt level is actually not that high. In percentage of GDP, US private sector debt today is slightly lower than it was in 2007. Why? Because in the US, who's done the big borrowing, the big leveraging has been the government of the United States, while the private sector has been more conservative. So that means in the US, you get the negative impact of higher interest rates, but it takes longer. It's much slower. You want to know a few countries that instead have a high debt service ratio? These are the countries where the cracks are already showing up. Canada, Sweden, Australia. These are countries where the debt service ratio is already higher, and these are countries where GDP is already growing at 0% effectively. Government bonds are generally forced on investors by regulation. Banks have to buy government bonds because of regulation. Pension funds have to buy government bonds because of regulation. They don't need to buy necessarily corporate bonds or mortgage-backed securities. Those are more risky, and you need willing buyers for these credit instruments, right? And so you can still find them, but it's harder. You cannot print money as easily as the government can. From the private sector perspective, it's much harder to kick the can down the road as it is for the government. So if you look at all crises in history, they all come from private sector leverage. You want to name a few? The Japanese real estate bubble crash. Well, that was because the Japanese real estate market and the private sector was too leveraged. You look at China today, you have the same problem. Private sector leverage is too high. You look at the Spanish housing crisis of 2012, the Asian tiger crisis. All of them come because of high private sector debt levels. Private sector debt is the most painful when it has to be refinanced at high interest rates and your nominal income is not going up. So when in real terms your debt costs go up, that's when it's the most painful, right? So inflation helps borrowers. Inflation helps debtors because their due amounts get inflated away effectively, right? Okay. So what really matters is the real cost of refinancing, the inflation adjusted cost of rolling over this big debt and these big liabilities. And I would say also that has been going up lately because inflation has been coming a little bit more under control in many places, including the US, but the interest rates instead are still very high. So what borrowers are finding here is high refinancing rates, but inflation rates that are clearly coming down and economic growth that is also clearly coming down. And that's the worst possible combination for highly indebted borrowers. I think disinflation is the way to go here, because if people become and corporates become more worried about the refinancing cycles at higher interest rates, they will slow down spending, they will slow down hiring, they will slow down capex, and so the labor market will slow, and so consumption will slow, and that is all disinflationary. And I think that's what we are seeing right now. And there are places where this has already gone on much faster, namely China. China is in outright deflation now for a few quarters and counting, because their private sector was too leveraged and the government has tightened up the screws on the real estate sector. And so now you're getting this deleveraging, you're getting this big refinancing issue, and the economy is slowing down so fast that deflation is happening over there. Japan has a very high government debt to GDP ratio. Also, Italy is a very high government debt to GDP ratio, right? Yes. So that's the story. And especially for Italy, the ECB has raised interest rates. So refinancing Italian debt is more expensive, but they still can. They can still issue Italian bonds, and investors are buying them because banks are forced to buy them and pension funds are forced to buy them, okay? So the pressure, the macro pressure coming from high government bond yields on a country with high government debt is not so high if you're issuing your government debt in your local currency. In euros in this case for Italy, in Japanese yen in this case for Japan. What is happening in Japan instead is different, because Japan is seeing their currency devalue pretty aggressively because the Bank of Japan is refusing to adjust interest rates according to the inflation picture in Japan. Inflation has been running way north of 2% in Japan, and these guys have only done a 10 basis point hike so far. 10 basis points. So if you look at all other currencies in the world, interest rates are much higher, and clearly what people are doing is they're buying other currencies and they're selling the Japanese yen against it, the so-called carry trade in FX, and this is putting pressure on the Japanese yen. But it is not something that comes from pressure on government bonds or government debt, because these government bonds are issued in local currency, in domestic currency. The fragilities come when the private sector has to refinance at higher interest rates because they cannot print money, and the government can print money instead. If you are an investor right now and you're invested in countries that have tried to hike interest rates as fast as the US, for example, the UK or Europe or Canada or Australia, okay? You're invested in these countries. They've tried to hike interest rates as much as the US. They've kept policy rates that high for so long. You should be a bit careful here, because these countries, Canada, Europe, UK, Sweden and more, they are not as equipped to handle high interest rates as the US is. They're more vulnerable, they're more fragile, and these fragilities are showing up. So people always like to talk about US markets, but there are other markets out there where people might be invested. Europe, Canada, Sweden, and so on and so forth, and these economies look pretty vulnerable here. The rates for the private sector are not the same that for the government. Of course, you are not the government, so you need to pay more to borrow, right? You're less credible according to investors than the government, so you need to pay a credit spread on top. And as the economy weakens, in history, every time you go and check, when the economy weakens fast enough and worryingly enough, credit spreads go up. Why? Nobody wants to land at the same low rates to the private sector or to a corporate if the economy is weakening. And so it's a vicious circle. The economy weakens, maybe a corporate would like to borrow some money to have a cushion. Well, all of a sudden they find out it's more expensive. Or the same goes for credit cards. It's a vicious circle that only happens close to recessions. I would say that if you listen to him at the last press conference, even after a full quarter of data, he wanted to talk about some cracks showing up in the labor market. I mean, you're the chair of the Federal Reserve. If inflation has been strong, you're expected to say, well, we're going to keep rates here, even think about hikes. And he instead wanted to talk about when are they going to start cutting rates. To me, overall, it's all going to be about macro data. And I expect the labor market to slowly weaken a little bit more going forward, inflation to come down a little bit more going forward. All of this is going to be like manna from heaven for Powell. He's looking to start cutting interest rates. So at this point, I would say July is for me the starting date of the Federal Reserve cutting cycle. And then I expect them to cut 2 or 3 times this year. But importantly, it's all going to be about how much growth and inflation slow down going forward. Economists are expecting US GDP growth to be 2.5% in real terms this year as well, and inflation to be 2.5%. I mean, 5% nominal GDP growth again. I think the consensus is getting very excited, very optimistic here. Maturity in the cycle, that's what it's showing. And I think it's typical, like in 2007, that people want to throw in the towel on the recession. And even they start talking about hikes are stimulative. I heard this last week, that interest rate hikes are stimulative for the economy. These are these theories that show up always at the end of the cycle. Like in 2007, you had the IMF and the Federal Reserve telling us we were in the middle of soft landing. The reality is that we are in a very mature growth cycle. And I think it makes sense to look at potential weaknesses going forward.